Hi, in this video I am going to explain adjustment entries. See, before you go for the problem, let me explain what is the meaning of adjustment entries and when it is required. Generally in an organization, at the end of the year, they need to prepare final account. The final account consists of three things. One is trading account, second one profit and loss account, and finally balance sheet. While they prepare the final account, they need to take the entire transaction which is related to the particular year, whether the amount is paid or not, whether the income is received or not. If the transaction is pertaining to the particular year means you need to record in your final accounts. See, while we prepare the final accounts, we used to take the trial balance value. From the trial balance only we can prepare the final accounts, but some entries or some transactions may not be recorded in the journal, ledger and trial balance. In order to prepare the final accounts on mercantile system of accountancy, all the expenses and incomes related to the period, whether incurred or not, whether the income is received or not, should be brought into account. For doing this, a concern is required to pass certain entries at the end of the year to adjust the various items of incomes and expenses. Such entries are called as adjusting entries. Okay, so the various adjustment entries is required to pass. After making the entries only they can go for prepare the final account. Look at this problem. Pass necessary adjustment entries for the following adjustment. First one is closing stock. Closing stock means stock at the end of the year. Unsold stock lying in the godown is called closing stock. At the end of the year only we can able to know the closing stock value. So you need to make journal entry for this. So what is the effect on the final accounts? The closing stock will be recorded credit side of trading account. The same transaction will be shown under asset side. For this you have to make journal entry. So in particular, closing stock account data to trading account 50,000. Okay, narration for bringing stock into account. Okay, so entry for the transaction is closing stock account data to trading account. So in trading account, closing stock will be credited. Okay, at the same time this will be recorded under asset side. So debit. Closing stock account data to trading account. Look at the second transaction. Salaries outstanding rupees 5,000. So what is the meaning of outstanding? Outstanding means not yet paid. The particular transaction is incurred during the year but you are not yet paid. But this transaction is related to or pertaining to the current year. So the net effect on final account is you need to add the outstanding salary along with the salary in debit side of P&L account, and the same amount will be recorded under liability side. Any expenses not yet paid, it is a liability. Any expenses not yet paid, that is outstanding expenses, will be liability. So you have to show under liability side. When you add outstanding salary along with the salary, debit balance will be increased. So entry for this transaction is salaries account data to outstanding salaries, amount 5,000. See, this outstanding salary will be added along with the salary under debit side of profit and loss account. When you add outstanding salary along with the salary, the debit balance will increase. So, debit the salary account. After adding outstanding salaries along with the salary, this will be recorded under liability side. So, liabilities or credit balance. Look at the next transaction. Prepaid insurance. So insurance is an expense. So any expenses paid in advance. So if it is outstanding means you need to add along with the salary in your final account. If it is prepaid means any expenses paid in advance, it will be subtracted from the respective account. When you subtract the prepaid expense from the particular expense, this will lead to decrease the debit balance. So automatically this will be recorded under credit side. Prepaid insurance account data to insurance 300. See, Prepaid insurance will be subtracted from the insurance in debit side of profit and loss account. This will lead to decrease the debit. So you have to enter credit side. If any expense increase, it will be debited. If any expense decrease, it will be credited. So credited insurance account. Why the prepaid insurance debited? Why? Because this will be after subtracting prepaid insurance from the insurance, this will be recorded asset side of balance sheet. So all assets are debit balance. Look at the fourth one. Interest accrued on investment. That is interest accrued. So it is an income. Okay. So outstanding interest will be added along with the interest. So this will lead to increase the credit balance. Entry for this transaction is outstanding interest account data to interest on investment. Okay, so interest on investment is already credited in the P&L account. If there is any accrued or outstanding interest, this will be added along with the interest on investment and the credit side of profit and loss account. While you add this item along with this will lead to increase the credit balance. So credit will be increased. No, again you have to credit this. Why? Because this will lead to increase the credit balance. After adding outstanding interest along with the interest and the credit side, this will be recorded in asset side of balance sheet. So all assets are debit balance only. No. So outstanding interest will be recorded under asset side. So all assets are debit balance. 700. Look at the next transaction. Commission received in advance. So commission is an income. So any income received in advance, it is a liability. Okay, so any income received in advance, it will be subtracted from the particular income. So income is credit balance. No, when you subtract this item, this will lead to decrease the credit balance. So you need to debit. So entry for this transaction is commission account data, commission received in advance account. Commission is an income. Commission received in advance, this will lead to decrease the credit balance. So debit commission account. Okay, so after subtracting commission received in advance from commission and the credit side of profit and loss account, again this will be recorded under liability side. So all liabilities are credit balance. So entry for this transaction is commission account data to commission received in advance account. Depreciate at 10% is to be charged on machinery standing in the books at 1 lakh. See, depreciation is a permanent loss. Depreciation means decreasing the value of asset. So asset is always debit balance. So when you subtract depreciation from machinery, this will lead to decrease the debit balance. So you need to credit. Depreciation account data to machinery account. How much? 10% on 1,10,000. Machinery is an asset. Depreciation is a permanent loss. This will lead to decrease the debit balance. So any item which decrease the debit, it will be credited. Because the machinery value will reduce. No. So credit machinery account. And what is the reason why the machinery is reduced? Because of depreciation. So depreciation is a loss. So debit all expenses and losses. So this will be recorded under debit side of profit and loss account. So entry is depreciation account data to machinery account. Look at the next transaction. 10% appreciation on land and building standing in the books at 5 lakhs. So what is the meaning of appreciation? Depreciation means decreasing the value of asset. Appreciation means increasing the value of asset. So this will lead to increase land and building value. This will lead to increase the asset value. So entry for this transaction is land and building account data to appreciation. 10% on 5 lakhs. 50,000. Okay, So when the value of asset increase, this will lead to increase the debit balance. So again you have to debit land and building account. Okay, so this will be the appreciation will be recorded under credit side of profit and loss account. After adding appreciation along with the land and building, this will be recorded, the same amount will be recorded under credit side of profit and loss account. So entry for this transaction is land and building account data to appreciation account. Look at the next transaction. To provide 10% interest on capital of rupees 5 lakhs. So interest on capital, this will be add along with the any interest, it will be add along with the respective account. No, so interest on capital also add along with the capital. So capital is a credit balance. When you add interest on along with the capital, again the capital will increase, the credit will increase. So credit capital account. Interest on capital account data to capital account. Okay, so interest on capital will be added along with the capital under liability side. This will lead to increase the credit balance. So capital will be credited, and after adding interest on capital along with the capital under liability side, the same amount will be recorded under debit side of profit and loss account. So interest on capital is an expense for the business. So this will be debited in P&L account. 10% on 5 lakhs 50,000. Look at the next entry. Interest charge on drawings. Say, drawing is the amount which is withdrawn by the proprietor from the business is called drawings. So, any amount withdrawn from the business for his personal or private use is called drawings. So, the company will charge interest on drawings. This will lead, the interest on drawing will lead to decrease the capital because the proprietor contributed some amount into the business. From the amount, he withdraws some amount for his personal use. So, the drawing will be subtracted from the capital. At the same time, interest charge on drawings also will decrease the capital value. This will lead to decrease the liability. This will lead to decrease the credit balance. So, you have to debit the capital account. So, entry capital account data to interest on drawings. Both drawings and interest on drawings will reduce capital value. So, both will have impact on capital. So, when you subtract this value from capital, the capital will always credit balance. No, this will decrease. The capital value will decrease. No, so debit capital account. Capital account data to interest on drawings. So, interest on drawing is an income for the company. Why? Because they'll collect interest on drawing from the proprietor. So, anyway, proprietor is separate entity, business is separate entity. Any amount received, it's an income for the company. This will be recorded under credit side of profit and loss account. 500 rupees. Next transaction. To provide provision for doubtful debts at 2% on sundry debtors worth 30,000. So, to provide provisions. So, every organization, they need to make some provision for bad and doubtful debts. So, according to this problem, they have maintained 2% on sundry debtors worth 30,000. So, on 30,000, they have to maintain 2% provision for bad and doubtful. Doubtful debts means may or may not recover from the debtor is called doubtful debts. So, for that, you have to make provisions. So, when you make provisions, this will be recorded under debit side of profit and loss accounts. Any provisions will be recorded under debit side of profit and loss account. So, entry for this transaction is profit and loss account data to provision for doubtful debts. How much? 2% on 30,000 is 600. This amount will be subtracted from debtor and the same amount will be recorded under debit side of profit and loss account. So, entry for this transaction is profit and loss account data to provision for doubtful debts. Next transaction. The proprietor has withdrawn goods worth 500 from stock. See, we have already discussed about the drawings. Now I told you, no, drawings means any amount taken from the business by the proprietor for his personal use is called drawings. It may be cash or kind. So here the proprietor has withdrawn goods. He can withdraw goods as well as cash from the business. Anyway, it is considered as a drawings. Anything which he take from the business is called drawings. So the proprietor has withdrawn goods worth 500 from stock. This will lead to decrease the purchase value. So already you have purchased some item for business purpose. From that purchase of goods, the proprietor has taken 500 worth of stock. So this will lead to decrease the purchase value. So purchase is always debit balance. When you subtract this value from purchase, it will lead to reduce the purchase. So credit purchase account. Drawings account data to purchases. Purchases is a debit balance. When you subtract that amount from purchase, this will lead to decrease the debit. So credit purchase account. How much? 500. Look at the next transaction. Goods worth 3,000 distributed as free samples to customers. Okay, so here they have purchased some goods for business purpose. Out of the purchase, they have taken 3,000 value of goods to distribute to the customer as free samples. So this will lead to decrease purchase value. So this amount you have to subtract from purchase under debit side of trading account. So this will lead to decrease the debit balance of purchase, and again you have to show the same amount under debit side of profit and loss account as advertisement, because we have distributed to the customer just like it is just like an advertisement. So entry for this transaction is advertising accounts data to purchases 3,000. So you have taken goods worth 3,000 from the purchase to distribute to the customer as free sample. So free sample means it is just like an advertisement expense. So this amount will be subtracted from the purchase under debit side of trading account, and the same amount will be recorded under debit side of profit and loss account as advertising expense. So entry for this transaction is advertising account data to purchase account. Next transaction. Goods in stock worth 6,000 are destroyed by fire. See, the 6,000 value of goods lying on the godown due to the fire accident, the value of 6,000 worth of goods destroyed due to fire. The insurance company accepted the claim for rupees 4,000 only. So what is the difference between these two items? 6,000 minus 4,000, 2,000 is a loss for the company. So already the 6,000 is loss because the value of 6,000 goods destroyed due to fire. No, this is a loss, but the insurance company accepted the claim only for 4,000. The remaining unclaimed or the remaining amount, the 2,000 rupees will be called as a loss, permanent loss for the company. So entry for this transaction is abnormal loss account data to trading account. 6,000 rupees value of stock destroyed due to fire. It is an abnormal loss. Abnormal loss will be credited in trading account. So entry for this transaction is abnormal loss account data to trading account. And you have to make another account also. So you need to close this abnormal account. For this you have to make one more adjustment entry. So entry for the transaction is profit and loss account data to abnormal loss account. So this abnormal loss you have to transfer to profit and loss account. First you need to find this abnormal loss in trading account. After finding the abnormal loss, this will be transferred to P&L account. So entry for this transaction is profit and loss account data to abnormal account. In profit and loss account, this will be recorded under debit side to abnormal loss. So how much? 6,000. So this is the entry. If we didn't receive any insurance amount from the insurance company, means you have to make entry like this. But according to our example, we have received 4,000 from the insurance company. So abnormal loss will be only 2,000. In this case, entry for the transaction is profit and loss account data, insurance company account data to abnormal loss account. So abnormal loss is 6,000. No, in that we have received 4,000 from insurance company. The remaining 2,000 is a permanent loss. The abnormal loss 2,000 will be transferred to profit and loss account. So out of 6,000 we have received 4,000 from insurance company. The remaining 2,000 will be permanent loss. This will be recorded in P&L account. So entry for this transaction is profit and loss account data, insurance company account data to abnormal loss. This entry will be recorded only when we receive any amount from insurance company, or else this will be the entry. Profit and loss account data to abnormal loss if we didn't receive any amount from insurance company. But according to our example, we have received 4,000. No, you need not write this entry. First you have to write abnormal loss account data to trading account. Then you have to write this entry. Profit and loss account data, insurance company account data to abnormal loss. So this is the first entry. And this will be the second entry for this transaction. Look at the next transaction. Bad debts written off. So what is the meaning of bad debts? So debtors are classified into three type of debtors. So first one is bad debts. Bad debts means irrecoverable. You cannot recover amount from the debtor is called bad debts. So you have to write off the bad debts from the debtor. This will lead to decrease the debtor value. In asset side, from sundry debtors, you have to subtract the bad debts from the debtor. Again, you have to show the same amount under debit side of profit and loss account. Why? Because it is a loss. So entry for this transaction is bad debts account data to sundry debtors. How much? 200. Why? Because when you subtract bad debts from debtors, this will lead to decrease the asset value. So asset is always debit balance. No, when you decrease the asset value, it will be credited. So bad debt is a permanent loss. This will be recorded under debit side of profit and loss account. So all expenses and losses will be debit balance. So entry for this transaction is bad debts account data to sundry debtors account. So look at the next transaction. Provision for discount on debtors. See, you can allow discount to your debtors. The discount on debtor is applicable to only good debtor, those who are ready to pay. Okay, they can avail this discount. So after subtracting bad debts and after making provision for doubtful debts, the remaining debtors are called good debtor. They are eligible to get discount. So you have to make provision for discount on debtor. So this will be subtracted from the debtor under asset side, and the same amount will be recorded under a debit side of profit and loss account. So entry for this transaction is profit and loss account data to provision for discount on debtors account. How much? 500. Look at the last entry. Provision for discount on creditors. When you purchase goods from our supplier, they will give some discount to us for prompt payment. So it is an income for the company. So when we receive discount on creditors, that is we are supposed to pay 7,000 rupees, but they allow discount for us 700. So this is an income for the company. So entry for this transaction is provision for discount on creditors account data to profit and loss account. How much? 700. See, when we receive any discount okay, from our supplier. This is an income for the company. Okay, so this will be credited in profit and loss account. Entry for this transaction is provision for discount on creditors account data to profit and loss account. When we allow discount to our customer, it is an expense. It will be debited in profit and loss account. So entry for this transaction, P&L account data to provision for discount on debtors. This will be recorded debit side of P&L account. This will be recorded credit side of P&L account. Hope you could understand this clearly. Thank you.